Hi, this is Steve Landrosiek with the Investment Planning Group. Today I'm going to talk about mutual funds and risk tolerance. This short video is part of an educational series designed to help investors who want to learn just a little bit more. You can find this video and others on our website by going to www.planipg.com. Go to the Resources tab and find videos. I recommend that you watch these videos in order. So today we're going to talk about first mutual funds, but we're going to just cover the surface. We'll have other videos that talk about mutual funds in greater detail because they come in all different flavors. Stock funds, bond funds, which is what we're going to talk about today, but you have precious metal, golds, foreign futures, all kinds of different things, small, big, and so forth. So we will talk about that, just not today, okay? So let's look at what a mutual fund is that contains bonds and what's a mutual fund that contains stocks, right? So the best way to think of it, in my opinion, is think of the condo. Many of you may own a condo, and you're part of this whole collective. You share expenses and other things and repairs and so forth. And each one of the people who live there, you and your neighbors, you're all kind of different in a way, right? So in a mutual fund, the mutual fund is the building. It's the collection. It has everything in there, all of the people who live there, right? So the condo is the mutual fund, and the individual investments are your neighbors, the people inside there, right? So I find that that's a helpful way of looking at what a mutual fund is. Bond funds are pretty much the same way. The collection of bonds. Today I'm going to talk about just treasury bond funds because I want to illustrate the point of risk, and treasury bonds are considered to be extremely safe. So I think that's a good way of illustrating risk. But let me give you an example of what you can find in a typical stock mutual fund. This stock mutual fund, the top 10 holdings, and they probably have anywhere between 30 to hundreds actually of investments. But when I look at the top 10, I see Microsoft and I see Amazon, I see Facebook, I see Berkshire Hathaway. Well, Facebook is really called Meta Platforms now, by the way. And I see Eli Lilly and Broadcom and so forth. So when you own this mutual fund, you essentially own part of each of those stocks, right? And the same thing with a bond fund. You get a bond fund and you have a bunch of different treasury bonds that are maturing at different periods of time, and they just reinvest the money for you, right? So why am I talking about mutual funds when really I want to illustrate the point of risk, right? So first I want to dispel some of the thoughts that are out there about taking risk. Many people will say, well, you're a young man, you can afford to take all of the risk, put all of your money in the stock market and so forth. You may be a young man or woman, you may also have all of that time, and you may also have benefited from being aggressive over the long term. But the question is, would you stay invested over the long term? And if you're not an aggressive person, I would argue no. So I disagree with the notion that your age, or certainly your age alone, is the determining factor that drives your risk tolerance. In a good market, everybody's happy. In a bad market, people are not happy. Some are less happy than others, I suppose, right? But I want to talk about the bad markets, the down markets. Because when the stock market is going up, and your statement is growing every single month because perhaps you have some of these stock mutual funds in there, you're going to be happy, right? So we'll focus on the bad years because that's what's going to determine how much risk you can take. That's what's going to determine if you're going to stay invested or not. Because if you don't stay invested, what good is it? A market cycle is between, say, 3 to 5 years. You should have at least 2 market cycles that you want to invest your money in, and maybe longer, right? So if you're a short-term investor, stocks may not be for you. But of course, that's something that you can talk about with your financial advisor. So let's look at the worst year in recent history. I have to say that is 2008. In 2008, the stock market was down roughly 39% change. Let's call it 40% because it's easy to do that kind of math, right? And ask yourself, if your investments lost 40%, what would you do? I don't think I'll ask you how you'll feel because I think I know the answer to that, but what would you do? Would you stay there? And even if you did stay there and it was 40% up the next year, it's 40% applied to a small amount of money because you just lost a bunch of money, right? So, that now extends how much time you have to stay invested and so forth. So how would you feel? What would you do if you lost 40% of your investments? Some of you may have lived through it, and some of you may have stayed with it, some may not. I find that a common thought process is, well, when the market's going straight up, I'm an aggressive investor. Because you want to be part of that, right? Who would not? So people tend to think about themselves as aggressive when the market's going up. When the market gets killed, people all of a sudden turn conservative. I'd argue you should do the reverse of that, right? And there's a video about what's a contrarian on our website, or I'm sorry, it is one of our blogs, but it's an interesting read nonetheless. So if you're the type of person that would not like that 40% down year, because you can't be conservative before the market goes down and aggressive before the market goes up, because we just don't know when that's going to happen. So you have to always assume that risk is at our front door, that it could happen tomorrow. How would you feel about it? Because you're not going to act before. Your advisor is not going to be able to act before. We don't know any more than you in terms of the future, right? We may know a little bit more about investments, but we don't know what the future brings, right? So how would you feel if the market was down 40%? And if your answer is, I wouldn't like it, I'd probably get out of Dodge, ask yourself another question. How would you feel if the market was down 20% or 10%? And just to illustrate the point, in a very simple term, you have a stock mutual fund that has the stocks that we just talked about. You have a bond mutual fund. And if you are only willing to have a 20% down year, I mean, you don't want to have any, but you can stomach that. That's half of the risk of the stock market. Maybe you should have half of your money or less in the stock market. You certainly should not have all of your money in the stock market if you're not willing to write it down 40%, right? So your risk tolerance should be defined by the worst year that you can think of and what you did and how you felt. Cut that in half, and maybe you're a moderate investor. You could be moderately conservative, moderately aggressive. Well, now we're talking a little bit about an art form and a little bit of finessing that, but you get the point, right? You shouldn't have all of your money in the stock market if you're not willing to take all of the risk. And that's where your risk tolerance comes into play, not how many years you have. The person who tells you that, they have no right to tell you, you have to sit through a bad year of 40% down because in the long term that's going to work out well. It may be truthful, but it may be bad advice if you wouldn't have liked the ride, right? So I'll conclude with this. It's a conversation you should have with your financial advisor. You don't get investment advice on the internet, on Facebook, even on our website. Investing is a full contact sport. Call your advisor, and if you don't have one, give us a call. 772-233-4315. You can also email me at info@planipg.com. Thanks for watching.